I'll start off, ladies and gentlemen. Listen, thank you very much for joining us here tonight, everybody. Many of our members advise their clients on financial matters, and they do so with great skill and integrity. Rarely, myself included, do we spend enough time focusing on planning our own finances. Tonight, IFAC accountant and ASA council member Philip O'Connor is joined by John Mulholland of FBD and John Lowe, the money doctor, to help you to become more financially fit in your own right. I'm going to hand over now to Philip to chair this session, and just as I do, I'll thank him for the effort and work that he's put into organising this event for us. Over to you, Philip.
Okay, thank you very much, George. Appreciate that, and thanks everyone else for logging on. As I say, look, we have two speakers. We'll be kicking off with John Mulholland, a senior financial advisor with FBD, and John will be really going through pensions. And look, it's a topic we all need to do, because unfortunately, we'll all get there at some stage. So it isn't very important that we plan for the future. So John Mulholland from FBD will go through that, and we look at it from private pensions to public sector pensions to what we should be doing, the do's, the don'ts, the questions you should be asking. And then after that, then we'll have John Lowe, the money doctor, who's years of experience in the financial services sector, if you know what I mean. And he's going to be talking about the other aspects like mortgages and just good financial practices that we should be doing and should be looking at. And we'll take questions after that. So any questions you have, just put them into the questions box. We'll compile them and we'll ask both speakers at the end. So John will give us 15 minutes, and then John Lowe will follow by 15 minutes, and then we'll have a questions and answers, and we'll have it all wrapped up before 9 o'clock. And say thanks very much. And John, I'll hand over to you there to start your presentation. Thank you.
Thank you, Philip. Good evening, everybody. I hope you're all well. My name is John Mulholland, as Philip has said, and I'm just going to share my screen with you now. Hopefully you can all see that. My name, as I said, is John Mulholland, financial planner with FBD Life and Pensions, and this evening we're going to talk about what we call our financial fitness webinar. In terms of FBD, just a little bit about ourselves as a company. FBD is Ireland's largest Irish-owned insurer. We have branches throughout Ireland, 34 individual branches spread across Ireland. In terms of our financial planning part of our business, it's quite separate from the general insurance side of things, but what is it and what do we do? So we have a team of financial advisors across our local office network. We provide advice on all our retirement planning, protection and investment needs by reviewing your existing arrangements to establish if they meet your current needs and if you're getting good value for your money. Ensuring that you're invested in areas to strike a balance between potential return and capital security, preparing and discussing with you a detailed financial plan, and most importantly, meet you regularly to keep you updated so that your plan is on track.
Okay, sorry, John, are you sharing your screen there for your presentation?
Yeah, I thought I had. Sorry. I think that's it now, is it? Yeah. Okay, sorry, apologies now, folks. Now, in terms of the retirement planning, this evening's focus. So pension planning comes in many forms, but tonight I have four specific types of pension arrangements and what to consider if one of them are applicable to yourself. So the four ones are regular savings pensions for self-employed and business owners, defined benefit pension scheme members, defined contribution pension scheme members, and also what we call preserve pension scheme members. There's also a little bit at the end about the pros and cons of income protection cover, what we might call the Rolls-Royce type of cover that's out there. Okay, it's just a little note on the state pension. There's a lot of talk about state pension and the sustainability and otherwise of it over the next years to come. There's a couple of facts that remain in terms of the state pension. At the moment, it's valued at around about 12,900 or 13,000 euros a year. So a not insignificant sum of money is being paid to our fully qualified state contributory pension holders. The issues that are faced with that is the fact that as a nation and as a population, we're growing older together, which means that there is going to be a hell of a lot more people claiming state pensions in the future That's obviously going to affect the viability of the state pension payments. At the moment, there is moves afoot to move or increase the pension retirement age upwards. It's been met with fairly stiff resistance, in fairness, from a political point of view, but I think inevitably it's going to happen. It's going to go up. What's that going to mean for ourselves? Well, I suppose at best, I think the state pension is really going to be a top up to your income. So the state pension of 12,900, very difficult to see it continuing to rise the way it has over the last 15 or 20 years. And then also, as well as that, there is talk, will it be there in the future? I'd like to think that it would. I think it's very difficult from a political point of view to say that they would remove state pensions in their totality, but the idea that they're going to be as generous in real terms as they are now in the future, or they're going to kick in at the same age, is frankly, it's not going to happen, essentially. So that's our state pensions. So if we think about that as our kind of a footnote in relation to what the state are going to do for us in terms of providing for our pension needs, this is where we have to look at our own requirements and see how can we provide pensions for ourselves. So a number of different ways that can be achieved. First one I'm going to look at here is what we call our regular premium pensions. So that's a pension that accepts contributions on, like, we'll say, a monthly or annual basis. This is applicable for yourself if you are self-employed or have your own company. There's some crucial features in relation to a pension plan. The tax relief you can get on your contributions of up to 40%. So for all our accountants or anyone who is anyway savvy in terms of trying to reduce their tax bill, a 40% contribution or tax relief in terms of the contributions that you make is excellent news, I would think you would say. If you have a company, your company can get tax relief on contributions if it makes those contributions on your behalf. So that's another way of saving a few pounds on the tax side of things. Returns on a pension, they're tax-free as well. So if I'm in a fund and the fund increases in value, there's no tax involved with that growth that occurs. So another outstanding reason to look at pensions as a way to provide for your financial future. There's many different types of funds. I'm not going to go into them really this evening in terms of what type of funds there is, but every fund out there is risk rated between the numbers of 1 to 7. And what you try and do then is pick a fund in conjunction with your financial advisor or broker that would suit your current financial outlook. And that will help you deliver, I suppose, the goals that you have set out for yourself in terms of personal pension funding. If you die before you retire your pension, it can be paid next of kin tax-free as well. And a company pension is trust-based, meaning that's ring-fenced from company creditors. So if they do come knocking on the door looking for, what they can see and what they can get, if things have gone wrong in your company, your pension is not one of the things that can be accessed in that situation if it's a company pension. So what would my pension be worth? This just gives an example in terms of contribution-wise. 3 examples for someone who's age 35, retiring at 65 with a 3% growth rate assumed over the course of those 30 years. So €300 per month gross would work out at 180 tax relief at the 40% relief, and 175,000 would be the final pot there, and you would get a quarter of that tax free, which is the second figure underneath that, the 43,750. I'm not going to go through all the figures there, but you can see yourself obviously the ability to make a regular contribution over a sustained period of time when you take into account the fact that the tax relief alongside with the growth that can be achieved, there's an ability to build up a fairly substantial amount of money, which will obviously go a long way down the road of providing you with a secure financial future when you get to the point of looking to finish up your working life. So what sort of questions should I be asking my broker in this situation if I have this type of pension? First things first, what's the current value of my pension? How has it performed over the last 6 or 12 months? That's obviously crucial to see, what track record, is it going up? Is it going down? If it's going up, brilliant. If it's going down, what's the reasons for that? Is there the fund that I'm in? Is it a more generalized reason? It's just to try and get yourself in the frame of mind of reviewing this on a regular basis. What type of funds is my pension currently invested in, and why? So the risk profile that's associated with my pension fund. This would be a crucial tool that I, as a financial advisor, would use, and we at FBD would use quite a bit. Is risk profiling our clients. You know, asking a series of financial-based questions, which would give us an indication of the type of fund that's suitable to yourself. So risk profiling really hones in on the type of fund that might suit somebody. So it's very hard to, like, in other words, you'd be assuming, you know, what type of fund might suit a certain person, but the completion of a risk profile gives a more nuanced view and a more accurate version of where that person should be putting their money. Does my fund choice remain the same for the duration of my pension? So in that situation there, am I in a situation where I make changes and switches to my fund? Does that automatically happen independent if I'm coming closer to retirement? That's really about understanding how the pension works. Another crucial one, what's my pension costing me? So in terms of the typical costs that go there, there's allocation rate, there's management fee, there's policy fee, encashment fees, bid offer spreads. Look, a pension's probably got a bad name in terms of some of the fees and charges that can be applied to them. There's a lot more transparency in relation to this sort of stuff in the last number of years. Anytime you're taking out a pension, you would be perfectly entitled, and indeed you are. It's actually a regular requirement that you're given a complete rundown in terms of the fees associated with the transaction. So don't shy away from that conversation. What age does my pension mature? So that's important, because if you're in a situation where you think, well, I want to retire at 50, but my pension is scheduled to run till I'm 70, you need to, you know, align those two things. And what value is my pension projected to be at the point of maturity? That's the crucial one, really, isn't it? That gives me an indication. Well, how big will my pot be when I get to retirement age? And is that money that is projected to be there going to be enough, in my view, to provide the financial security that I'm looking to have? So moving on from there, defined contribution of DC pension schemes. This is a pension that also accepts contributions monthly or annually. It's applicable to you if you are working for a company and your employer or you are paying into a scheme. So essentially, you know, defined contribution schemes, the name is a giveaway, it's a defined contribution. So the amount of money that you pay in is defined. There's no guarantee in relation to the returns in relation to the pension itself. Tax relief, again, is available on it. Your company qualifies for tax relief as well. The value of contributions are normally based on a percentage of your salary and are typically agreed when you join the company. Most people mightn't be aware actually of what percentage of the salary has been paid into their company pension. Generally speaking, it's made up of a mixture of a certain amount paid by your employee, i.e. a percentage of your salary, and a certain percentage paid by yourself as well. The returns on this type of pension, they're not guaranteed. This means that the value of your fund at retirement may be higher or lower than expected. So that's an important one, obviously, to be aware of the fact that there is risk involved with that type of pension scheme, and you need to be able to manage that, accept the risk that suits your type of financial outlook, and keep an eye on it. The range of funds available are generally limited. So in terms of defined contribution schemes, you will find that there's typically a larger amount of people. So there's a pool of people obviously paying into the defined contribution scheme, as in the employees of a certain company. For simplicity's sake, you will find that a lot of those defined contribution schemes, they won't have a ginormous amount of choice in terms of the funds that's available. You'll typically have a generic low, medium, high risk option with maybe 2 or 3 extra ones thrown in. The fund pension maturity will coincide with your retirement date as well. So that's the time, obviously, the money becomes available. For DC members, what questions should I be asking my pension administrator? First one, what's the current value of my pension? How has it performed the last 6-12 months? You're probably seeing a bit of a pattern there in relation to that. You're just trying to get a grip in terms of what your pension is actually doing. What type of funds am I currently investing my money in, and why? So again, that's back to the risk profiling piece. I find by experience, a lot of defined contribution schemes are set up at a certain period of time, and there's very little, if any, conversations had after that point with the individual, what they call member of the scheme. So the risk profiling that was set up on day one typically might bring a person right the way through until they either retire or leave that company service. So it's important to maybe try and get an idea of where your pension is within that, and is it right for you. Does my fund choice remain the same for the duration of my pension? Is lifestyling part of my pension? Lifestyling, the way it works is that if I'm in a situation where I'm perhaps 10 years out from retirement, oftentimes a defined contribution scheme, again for simplicity, again because they're managing a group of pension as opposed to an individual pension, they will automatically move money that you have saved up in your pension into a lower risk fund in blocks over the period of the time that you come close to your retirement. So that's called a lifestyling. It's, I suppose, a way to de-risk or de-leverage the actual pension fund itself. It can be good or bad depending on when it starts, when it finishes, and obviously what your intentions are in terms of the pension itself. But I would always look to see, is it what you want in relation to your setup? And you know, if it isn't, you can take yourself out of the likes of the lifestyle option with most defined contribution schemes. What's my pension costing me? So the same again in terms of allocation rate, management fee, policy fee, bid offer spread, etc., etc. All very important questions. What value is my pension projected to be at the point of maturity? Can I get a SORP? A SORP is a statement of reasonable projection. So that's an indication of, based upon the current criteria in terms of how much I'm paying in, what fund I'm investing in, and what the value of my pension is. What at retirement, what will my actual pension be worth? So that's what the statement of reasonable projection should provide to me. I think it's a useful thing to have because it gives you a clear and concise view of what the provider's viewpoint is in terms of your pension and how it's going to perform in the years ahead. And you can quickly then look and see, for example, well, what's the projected growth rate that they're using? So if they're using a very, very low growth rate, it probably means that your pension fund is in a very low risk approach, which might mean that the returns will follow through in terms of the return of the growth rate that they're projecting, and that can have an adverse impact in terms of someone making a lot of contributions and saving into their pension over a long period of time. If they're not getting good growth alongside it, it can disappoint. The returns can be a little bit disappointment in that situation. Another crucial question: what happens to the money if I die before claiming my pension? So for most people, in terms of that, for a DC member scheme, there'll be two parts of that. It'll depend in terms of whether my company has what they call a debt in service liability as well. So a debt in service basically means that I work for my company, I die, they might pay out a multiple of my salary to my next of kin in that situation, maybe 2 times, 3 times, even up to 4 times my salary. The defined contribution scheme then, typically speaking, is paid in on top of that as a lump sum as well. So you need to just, I suppose, be one thing you need to be conscious of in relation to that is who is that money assigned to. So I've seen in the past as well with defined contribution schemes, when you join them, to say, okay, if you were to die, who should this money go to? If your life events have happened, perhaps you've got married in the intervening period, or you have someone else that you would prefer the money to go to than who you said at the start, it's important that you review that to ensure that's still meeting your needs or your wishes at that time. Okay, defined benefit schemes and semi-state, I suppose state and semi-state employees. This is a pension that accepts contributions annually. Now, this is a crucial difference. It's applicable if you work for a company that has defined benefits. That has a defined benefit scheme. Now, they're very rare at this stage, and more likely this type of pension is applicable if you're a state or semi-state employee, which is also realistically a different type of defined benefit scheme. Without getting too bogged down in that, I suppose quickly, if I'm a Department of Agriculture official and I'm a member of the pension scheme there, what happens is it's based upon essentially my salary and service over a period of time that I work for the department. In relation to the scheme itself, it's not actually what they call a funded scheme, so it's paid out of exchequer, the government exchequer expenses on a year-to-year basis. So there's no actual pot in the background in relation to that, as to say, well, this is the value of my pension. It's more to do with the likes of the service that I built up. So it's a far more difficult scheme to quantify in terms of its value or otherwise, because there is an unknown factor in the background in relation to it. I suppose in terms of FBD's position in relation to it, we would be more in the space of advising people who define benefit schemes, for example, people who have worked in banks and so on and so forth, that maybe had defined benefit schemes that have closed or wound up, or they have left them due to go to new employment or whatever it may be. So there is a significant difference in relation to that. In terms of the defined benefit scheme, the selling point of defined benefit scheme back in the day was that this type of pension offers guarantees. So the benefit was guaranteed or promised to you that once you made a certain time commitment to your employer and you had a certain salary built up, you would be entitled, as they call it, to a defined pension at retirement age. The pension maturity would coincide with your retirement date as well. More difficult, I think, with defined benefit schemes, they would have been seen as the gold-plated pension option for a long number of years. What's happened with, I suppose, with employee defined benefit schemes now is that they have a lot of them have been closed because the liabilities that built up, in other words, the promises that the scheme has had to make for future pensions, has become a huge amount of money, and schemes have made the decision to say, well, we're going to close this to new members and we're going to close it to future contributions because we feel that we're not going to be able to stand over the commitments that we have to make in this situation. As I said, that's totally different from the semi-state and state employee situation. That's more built around I suppose a exchequer question more than anything else. In terms of the DB side of things, a couple of things to always be asking your minister: how is the scheme performing? Is it well funded and on track to meet its future pension obligations? So if my scheme is what they call underfunded or is in deficit, that's a canary in the mine, if you like, in terms of saying, well, a deficit means that the scheme feels that there isn't enough money within the pot itself to make good on all the promises they've made into the future. And that would be, an initial starting point for a lot of pension schemes to maybe either do one of two things. That would be to reduce the future promises they've made in terms of the pensions, that they had promised they're going to give someone into the future, or secondly, maybe close and wind up the scheme if they felt it was totally unwieldy or unrealistic in that situation. Another one for DB members: I won't have full pensionable service built up on my expected retirement date. Normally a 40-year service. Can I pay into an AVC pension facility? So that is one that I would see a lot of public sector employees doing. They would pay into AVC pensions. An AVC is an additional voluntary contribution, so it's money paid by the individual themselves. Tax relief is available on it. It grows tax-free, but it's separate from, we'll say, the state pension side of things. So a lot of people might build up an AVC pension with a view of taking it as a tax-free lump sum when they reach retirement age, and that would impact upon the level of day-to-day or guaranteed pension that they would get from their defined benefit side of things. What happens to my pension fund if I die before claiming my pension? So again, in terms of that, has been changes in relation to scheme, how money is paid out from schemes in relation to pensions. There was a rule prior to now that if there was more than 4 times salary in the pension pot, that they would have to take what's known as an annuity. But the government have removed that rule there just at Christmas time. So that has freed up the money, and has meant that for a lot of people to be in the situation that if they were unlucky enough to pass away, that the entire value of their pension pot becomes available for their next of kin, payable as what they call into an approved retirement fund, or even into a taxable lump sum, depending on the particular arrangements. It's one that you probably need to get advice with if something like that did apply. What's the projected value of my pension likely to be, and what tax-free lump sum will I get? So again, that's relation to, from a DB side of things, that's really a lot of that element is built up with the amount of time I've spent, what service have I done, a pensionable service have I got, and what applicable salary have I got in relation to it. So there is calculations a lot of times that DB schemes will give you. Again, it comes to what they call a SORP, a statement of reasonable projection, and that will give you all that information as to what the pension is likely to be. Oftentimes a person might get that out, and on the foot of that information might decide to set up an ABC pension as a ancillary or a boost to their pension because they feel that the projected value is not where they need it to be. So preserved benefits and I suppose deferred members. Preserved benefits refer to the fund that you've accumulated in a pension scheme and then left that employment. Many people who have worked for more than 2 years in a company and then left will have one of these, obviously providing the company had a pension scheme in place, of course. The main features, so if you have a preserved benefit or you're a deferred member, contributions are no longer being made to the pension. It's now what they call paid up. Because you've left the company and therefore the pension scheme, you're now a deferred scheme member. So you're still a member of the scheme, but you're not an active member, you're deferred. If the scheme is a DC or defined contribution, your pension continues to be invested and returns are still not guaranteed. So lifestyling, automatic switching, retirement age will all still apply. If the scheme is a defined benefit, your benefits are preserved, and if left until the designated retirement date, the pension scheme is a liability to you, and therefore you should get paid an annuity from that date. This is obviously based upon the scheme being financially able to do this. So that's where it comes down to, back to my previous slide about seeing what's the financial strength or health or otherwise of the pension scheme in that situation. Is it fully funded? Has it enough money in the pot to make good on the promises that it's made in terms of the guaranteed pensions it's going to provide at retirement? I just underlined here, former semi-state and state employees are not eligible to transfer to the bank the DB scheme pension entitlements. So, as I said, it's a different scenario for that situation. That's the preserved benefits. A couple of things in relation to this. So, the questions I would ask if I was a preserved pension benefit holder: how is the scheme performing? Is it well funded, on track to meet its future pension obligations? What happens to my pension fund if I die before claiming my pension? What is the projected value of my pension likely to be, and what tax-free lump sum will be entitled to? So they were all really questions that we've covered already in terms of the answers to them. They may change obviously a little bit because of the fact that you're no longer making contributions towards your pension. So that's why you need to be updating that situation to see, well, based upon the fact there's no more contributions being made, what impact has that had upon all those questions that I have. One important piece here is, what is the transfer value of my current pension entitlements, and is the scheme in a position to offer enhanced transfer value? So this is something that's come to light, I suppose, over the last number of years, specifically with defined benefit pension schemes, in the sense that pension schemes are actively contacting deferred members or deferred members and saying to them, we are in a position where we'd like to offer you a certain amount of money, i.e. a lump sum, to take the pension away from us. So that would mean that we would no longer have a pension obligation to you as a former employee. You would take this lump sum and you would put it in a pension fund in your own name. So it has become popular. I've seen enhanced transfer value. So essentially, an enhanced transfer value is really a situation where the defined benefit scheme is saying to the member, we feel that your pension at this particular time is worth a certain amount of money, but because we want to maybe move on from this, we're going to top that up by maybe 10 or 15% in this situation. Again, enhanced transfer value is if a scheme is actively offering members an enhanced transfer value. That to me would indicate, there's a reason behind that a lot of the time. It can be from the fact that maybe, as I said, the underlying scheme itself is maybe not particularly well funded, or the company itself is withdrawing from, you know, the locality and looking to minimize its future obligations in the area. But it can be a very interesting conversation to be had with people. I've seen real life examples where pensions have been offered and values have been put on the table, which are very, very significant in a lump sum amount of money. So it can be potentially a life-changing thing that can happen for somebody. Instead of depending on a guaranteed level of annual pension, I can receive I can receive a lump sum from the company, and from that I might be able to take a quarter tax-free and a few other things like that. So it's an interesting and very, very I suppose it's a relevant part of pension discussions at this particular period of time. In terms of that, the preserve pension piece, if somebody was in that situation, one option that potentially is out there is what they call a personal retirement bond, or a PRB. A PRB is a transfer of your pension entitlements from the previous employer's pension scheme into a new policy in your own name. It's still a pension, but it's now in your sole name, and all ties to the previous employer are removed. So why would I put what the PRB in place, or the buyout bond as it's called? Some reasons are as follows: the scheme is winding up or the company is closing, the scheme is underfunded, has a lot of future liabilities, the scheme is offering enhanced transfer value to take my money, you wish to access the pension. So PRB allows access from age 50. There's a bit of work involved with getting at the pension from age 50, but it can be done. You want to control your pension and choose the funds and invest, and growth is tax-free. So in other words, you take your lump sum away from your defined benefit scheme, put it into the PRB, and then you put it into a fund that matches your risk profile, and you track the performance of it on a more, I suppose, a more one-to-one basis, as opposed to leaving it to the managers or the trustees of a defined benefit scheme to manage your money on your behalf. In terms of the personal retirement bonds, FBD provide a lot of advice. This would be an area we would do quite a bit of work with clients who may have had money in pension schemes. For example, someone who's left employment through redundancy or otherwise, we'd have our client liaise with their previous company's pension scheme trustees. We have been able to arrange enhanced payments from the scheme for members through our expertise in the areas of SCSB, which is standard capital superannuation benefit calculations. I'm not going to go into that now. It's as the name is a mouthful. The calculations are another day's work really, but there is a calculation by which we can talk to employees to make sure that what the deals that they're putting onto the table for their former employees are actually correct and where they should be. So in conclusion, if you or your spouse are in redundancy talks with your employee, or either if you have a paid up pension from previous employment, I'd like to think you could talk to us in FBD before you commit to doing anything with it. That is the pension side of things. Just a couple of quick slides on income protection. And I suppose I would call, as I said here, income protection the Rolls Royce of cover. Why do I say that? Well, it's a policy that will pay your regular replacement income if you can't attend work due to accident, sickness, or injury. So a lot of policies like life cover, there's a defined payout in relation to life cover. Obviously, if you have to die. Serious illness cover, there's a list of serious illnesses, and if I get one of the illnesses on the list and it's of the particular severity that's defined on the terms and conditions, I get my money out. In terms of income protection, it works differently. As I said, you have to be off work due to accident, sickness, illness, or injury. There isn't a defined list of illnesses that will pay out in that situation. So, for example, things like non-specific back pain, or something like somebody who's off work long-term, maybe due to anxiety-led reasons, mental health issues, that can lead to a payout from income protection. It's always arranged on a sole life basis. I think it's it typically arranges a cover with a deferred period in time. So that's the length of time that you must be off work before the payments will start. This can be different periods of time, but it's from, we could say, the 8-week up to 13-week basis, 26, 52. There's lots of different deferred periods. And the payment will continue until you return to work or the policy matures. So, for example, at the start, you set an age that you want the income protection to run to 60, 55, 65, so on and so forth. When considering income protection cover, ask, will your employment type qualify? So manual and labor-intensive jobs not something that the insurers are that interested in. Office-based sedentary roles are where income protection is at in terms of being able to achieve to get that cover. There's no prescribed list of illnesses, so we'll pay for things like stress-related absences or surgeries, etc. One thing I'd say about income protection, can be difficult to get it in place. You know, their underwriting is reasonably stringent, so don't wait till you get ill before you attempt to arrange this cover. So the horse is bolted at that stage. I think you'd be running yourself into a lot of heartache to try and get the cover in place in that scenario. One outstanding feature of income protection is that there is tax relief that can be claimed on the cost of cover. So it's €100 per month premium, and you're paying tax at the higher level, you might get 40% relief on that. Proof of income is required to claim, so there's no point over insuring. Up to 75% of current salary for cover purposes is allowed, and if applicable, income tax is paid on the claim. So if I'm in receipt of €3,000 a month from my insurer for my income protection cover, I will pay income tax. It's like essentially what you become an employee of the insurance company in that situation, and you pay income tax and PRSI, USC as you would on your normal salary basis. I just ran a couple of quick quotes in terms of cover. Just wrote at the bottom there, the above quotes are subject to underwriting and not guaranteed. So they are, example quotes, I like to stress in relation to that, but they're reasonably accurate depending on, someone's, as I said, health status and current situation. So first one is male, age 40, non-smoker, good health, class 1 occupation. So how income protection is classified, there is every job is put into a class between 1 to 4 or declined. Class 1 is seen as the lowest risk, typically your office-based sedentary type roles. Cover for €50,000 annual payment. In the event of claim, you get that paid in monthly installments. Run to age 60 with a 13-week deferred period, so you'd have to be off work for 13 weeks before the payment would kick in. You can see their monthly premium is €103 or $62.70 when you factor in your tax relief. And female age 50, €30,000 in the situation, class 1 again, NRA is 65 with an 8-week deferred period, so a lot shorter deferred period. Monthly premium is $156 or gross of $93. The deferred period has a big impact in terms of the cost of cover, along with age and the length of time you want the cover to run for as well. So they're just examples of what income protection would cost. And as I said, in terms of certain occupations, I think it's a cover that can provide a significant peace of mind to somebody to say, okay, well, I know I can replace my income for a very, very long period of time at a reasonably cost-efficient manner when I factor in the tax relief in relation to it. So it will be popular among a certain cohort of clients based upon, as I said, their occupation. That's basically my presentation, folks. I hope you enjoyed that. There's my contact details up there on the screen, and I'll be happy to take questions at the end of the presentation. But what I'm going to do now is I'm going to unshare my screen, and I'm going to hand back to Philip.
Thank you very much, John. I actually just have one small question before we go to John Lowe. We have a couple of young members on the group. Where would you start? Do you go to you? Do you go to your employer?
Well, that depends on the type of situation you find yourself in, Philip. So, as I said, are you an employee? Are you self-employed? Do you own your own company? They're the key points in relation to where your pension starts out. So, if I'm a self-employed person, the first thing I'll be doing in that situation, from experience, the reality is I'll be making my tax returns, and am I making a profit in terms of my business, whatever it may be. And from there, then you would naturally feed into perhaps a pension contribution. For most people, I would find their initial time, a lot of people would start working in a company, so you'd be looking at the defined contribution company pension scheme is the most regularized or most obvious choice in that situation for a lot of people, Philip.
So would they go to their employer, or would they go to you? Like, or how?
Well, as I said, in terms of, let's say, for example, I join FBD in the morning. FBD have a defined contribution pension scheme. So when I sign my contract to join them, I join the pension scheme unless I'm underneath the age for where I actually need to join them. But in that situation, I automatically join into the pension scheme, and from there you would be sent out your annual statement. So that would be the general rule of thumb from a company employee perspective.
Okay, thank you very much, John. That was very informative. We'll hand over to John there and the money doctor now to take us through just good financial practices and looking at mortgages and all those wonderful things. Thank you very much, Joe. You can take it over there, John.
Thank you very much indeed. I'm going to share the screen again with you. Where am I there? So, first of all, good evening, ladies and gentlemen. I say thank you for your patience, and thank you, John, for your good presentation. Basically, I'm going to talk about mortgages and a couple of other financial instruments that are really, really important. But the mortgage, and in fact, your biggest single purchase in life is your home. So you've got 10 lenders at the moment, of which they're going to be shortly 8, because KBC and Ulster Bank have given notice to quit. Ulster Bank will be gone by the third quarter, and KBC will be gone shortly after that. So it is getting more competitive, even though there's less. With the arrival of Avant Money in particular, and Finance Ireland, it's starting to hot up again. So TILE is an acronym for all you need to know about mortgages. So beginning with T for terms and rates. So you've got up to 35-year term if you've got the youth. So a 34-year-old will get a 35-year term. Maximum age is 68 or 70 if you own your own business, like if you have a pension, basically. Standard rate or fixed rate, they're the two types of things. So under 50%, for a standard rate, you're looking at 2.7%, 50 to 80%, 2.9, and over 80, 3.15. Now, the thing is that you can get actually fixed rates, would you believe, of 1.95%. That's 3, 5, or 7-year fixed, absolutely fantastic rates. So it's certainly around there. Eyes for income. So all lending is based on the ability to repay. So again, we go back to the multiples of annual income, 3.5 times joint annual income. But this type of year is actually very important, because for the first 3 months, all of the lenders are given a discretion, usually about 20% of their total loan book. So if you're doing 500 million a year, then you'll be allowed to do 100 million at whatever you want, basically up to 4.5 or maybe 4.75. So if you're a professional class, accountant, solicitor, dentist, doctor, you might get that kind of allowance. So bonuses over time, they can be taken into consideration as well. You must be permanent and you must have passed your probation period. So the Central Credit Register is now the only credit agency, and they will be checked every time. If you've had a blip, you've missed one payment, you can forget about getting a mortgage. So you've got to guard your good name. And that centralcreditregister.ie, you can either phone or you can send in an email to them with your name, your address, your date of birth, and in a couple of days you'll get a report back as to how your credit history is. So you got to guard your good name. L is for loan to value. So first-time buyers, 90%, second-time buyers, 80%. Residential, if you're going to residential investment, that's 70%. So E is for expenses. So what is this all going to cost you? Apart from the 10% if you're a 90% borrowing, that's for first-time buyers. So it's 1% for stamp duty under $1 million. Legals, generally about 1%, but what I suggest you do is you shop around. You can get it for 0.5% in some cases. The valuation fee is about 130. Now it's gone up to about 150. And you might need something more if the property is in bad order and you need to get a structural report. That could cost you up to €400 or €500. The basic furnishings, people forget about that. When they buy a house, they've got to put the basic furnishings in, like a bed and a TV and a fridge, washing machine, plus of course your deposit. So the Help to Buy scheme is still there for those first-time buyers, and it's quite good. First-time buyers only, new home or self-build, maximum is 10%. That was the last July stimulus, or 30,000. So I remember seeing properties in Bettystown, 3-bedroom, semi-detached house, fabulous, right on the golf course, overlooking the sea, going for 299,000. What you would do therefore, if you're a first-time buyer, you're getting your deposit for free because you get 30 grand. So and you must live there for at least 5 years. It only applies to new properties less than $500,000, by the way, and also it comes from your last 4 years income tax and dirt tax. Well, there's nothing on dirt tax, but your income tax. So if you haven't worked or you've just started work, then it'll be very difficult to get that full Help to Buy scheme. So to start the process, simply complete a property information form online through Revenue's My Account. These notes will be available, by the way, afterwards. So what else? You'll need at least a good savings record, a permanent job plus past that probation period, 6 months, good current account statements, meaning no referrals, unpaids or blips. That includes Paddy Power referrals, by the way. The same for credit card statements and loans. Do your own personal budget. Remember, it's you who have to repay the mortgage. How many people are quite happy to be given a huge amount of money, which they don't really think that they can afford, but because they've been able to wangle it, they get the loan. And then they find out after they got the loan, they actually can't afford it. So remember, it's you who pays that mortgage. Anything else? Yes, there is. There's insurance, life cover on the mortgage in case anything happens to you or both of you. Buildings insurance, in case anything happens to the house, you have to get that on. The lender will want to see buildings insurance. Content insurance for yourself, including those golf clubs, precious jewelry. My golf clubs years ago were stolen. Well, they weren't stolen, they were left. My car was stolen, and the clubs were left in the boot, and the car was then set on fire. So I got a new car and I got a brand new set of clubs. Anyway, it worked out well in the end. So you should have about 5,000 for furnishings and white goods, and you'll need that when you move in. So now what do you do? Well, you go to the one-stop shop for both mortgages. We have most of the agencies. Life cover, we have all the agencies. Buildings and contents insurance. So all at no cost to applicants, because all of these providers, they pay us a fee for the placement of business. So it's in our interest to make sure you get the best deal. So you can contact Money Doctors for a Zoom. There's a moneydoctors.ie. There's a kind of one-to-one consultation process on the main kind of web page, the homepage. That's the telephone number and that's the email. So this is a quick 10 steps. I'm rushing through this because I know that we're running out of time, but 10 steps to kind of transform your finances. Have an emergency fund. I always say you should have between 3 and 6 months net annual income or joint net annual income for those emergencies, a sudden loss of income, or that investment opportunity, even like getting a deposit, paying off expensive personal loans and credit card debt. One of the best credit card debt providers, by the way, is Unpussed Money, who give you 15 months. If you've maxed out your credit card and you can't pay it off, January is a bad time generally for credit cards. You can transfer the lot over as long as you've got good credit history over to Unpussed Money, and you'll get it for 15 months. So if you had a €1,500 loan you can't get rid of, you pay off 100 a month for 15 months and it's gone at the end of 15 months. Short-term savings for cars and holidays. You know, that's what you need. We all need to save. Income protection, John already mentioned that, in case you're unable to work, in particular for the breadwinner in the family. Life insurance for you, and if you have in particular dependents, you need a separate policy for life insurance if you have dependents. One other thing, those of you who smoke, and you've got a mortgage protection policy, if you give up smoking and after 12 months you go back to that life insurance company and you said, I've given up smoking, you will have your premiums cut by 50%. Well worth your while, just not only on health grounds, but on financial grounds. Starting a pension, John's already mentioned that. It's never too early. We have a real problem with pensions, I can tell you. Buying a house with the help of a mortgage, again, important budgeting, which I'll go through in a second, protecting your assets and possessions, and also building up your personal investments and planning long-term care. It's not about, waiting till you're 70 and then worrying about, what am I going to do about my money then? So budgeting, this is a very quick one. At least once a year, you should have a budget. Live within your means, spend less than you earn. When budget is complete, you ask yourself 2 questions. 1, do I need it? 2, is there a better or cheaper alternative? The 3 choices then, if your expenditure happens to exceed income, is you either earn more, cut costs, or you prioritize. And that's why over the last 5 years, 300,000 people stopped paying their health insurance. They couldn't simply afford it. So don't forget your spreadsheets and apps. Now, this is one spreadsheet, and any of you want to email me afterwards, I will give you this little budget planner spreadsheet. It's a brilliant one with all the different categories on it. And then it tots itself up and takes it away from your. So it's a really important exercise at the start of the year to work out how much does it cost me to run my life on a monthly basis, and everything is there. You've also got help from this app, which is free. It's a Money Doctors app. And again, there's 13 categories. You categorize this for, say, over 4 or 5 weeks or a calendar month. And it's all your costs, like your lattes, your pints, your newspapers, your magazines, your petrol, all in there. There's even an online portal there as well. So at the end of 4 or 5 weeks, you press a button, you get a report, you get your top 5 spends, total amount you spent, and geographically where you spent every cent. So it's really, as I say, and it's free. Really, the one guy kind of came into me and he said he had to have 3 lattes a day. I said, 3 lattes a day? Do you know how much that costs? He says, I don't care. He said, he had a shake in his hand. And I said, well, let me tell you, it's going to cost €2,000 gross net. Gross it up, it's 4 grand. So you're guzzling coffee at 4,000 a year. Far ahead. As long as you're aware of it, this is what this exercise is about to be. So Ireland's aging population, John already referred to this, like in 2021, we had 667,000 people over the age of 66. By 2051, 30 years time, there'll be 3 times that amount. And a sobering document, if you want to read it, is the population aging in the public finance in Ireland. It's a summary, and it was from the Department of Finances. I can tell you, it really is sobering. We're living longer. We're becoming healthier and fitter. Age expectancy is now mid-80s for both genders. A pension time bomb, because I simply think that the government will not be able to afford it. 2021, we had every retiree who was retiring. There were 5 workers. In 30 years' time, there'll only be 2, and 3 times the population of retired people. So I reckon that by 2041, the state pension, which is €248, 30 cents a week, could be scrapped. So John's already mentioned this, and that's the 3 reasons why you should have a pension. It's one of the best investments in Ireland because you're getting tax relief on it. In the inheritance and succession planning, again, capital acquisition tax, you should know this, like 335 from a parent to a child. If you look at 2009, it was 542,000. You can also give your grandchildren 32,500, and anybody else, including me, 16,250. So remember, there's also gift tax. You can give your sons and daughters each 3,000, and that goes for your, say, if there's a mother and father, that's 6,000 per child, and that's outside of inheritance. So you can put that away every year for them if you have the money. So, I mean, there are 3 guys who know what they like reading. The bottom line, though, is all people need advice from someone they trust. They're maximizing the return from what little money they may have, and supporting investments, debt management, and financial strategies. They also need to make a will. And sadly, 70%, believe it or not, that's the percentage of Irish citizens who have not made a will. And young or old, if you've children and or 25,000 plus, you should make a will. It's nothing morbid about it. It's just a matter of fact. And then 99% of those 70% of people have simple, non-complex relationships and estates, what you own. And you do not need a solicitor at all for either the drafting of a will or to do the probate. Last August, we launched a low-cost DIY wills and probate service. And basically, you get 8 documents. 3 of them are Word documents, which includes the will template itself. That's one of 6 types. So if you're married with children under 18, there's a template there for you. If you're married or civil union with adult children, there's a template there for you. So the list of assets, these are all kind of Word documents, which means that you download these 8 documents, and there's a film to tell you how to download. And you put them into your own PC or your laptop. You pull them up on your laptop, not mine, not our website, and you fill it out. Everything is there, including the supporting documents. You are in control. There's 10 tips before you complete the will, which includes all about witnesses, what you need to know, executors, executrices, and plus then you're empowering your representative to apply for the grant of probate. Can I just tell you that if you were going to do the probate yourself for your mum or your dad or somebody who died close to you, you would then, and you decide to do it online, you get in touch with the probate office. The link, the web link that they tell you to click into is www.courts.ie/applying-probate-without-solicitor. That's their web link they give you. So applying probate without solicitor, you don't need a solicitor, in other words. And you'll save the estate absolutely thousands. So as long as you put that will away with the list of your assets and personal information so that the executor or executrices know where it is. The cost of all this is only €50. And I'm not doing it for the money. I'm doing it to try and get those 70% in Ireland who haven't bothered, who haven't done it because they're probably overwhelmed by it all. That it's so simple. Just, do it, as Nike used to say. So that's where you go, moneydoctors.ie/wills. So really, knowledge is power. You've got to inform yourself, reading, attend seminars and webinars like this. Understand the jargon. I have a website which has all the jargon on the homepage, actually. Spend time on your finances. Again, 2 hours a month. You enjoy planning, saving and spending, and be positive and hopeful, because no matter how bleak things are, there's always hope. Now, believe it or not, and Elvis is even reading my book, and is actually doing quite well at the moment. If he had read that, he wouldn't need Colonel Tom Parker. Anyway, 48 hours, the reason why that's there is because normally when you see a presentation of this nature, if you don't do anything in that 48 hours, then this really has been a complete waste of time for yourself. So there's my number, there's my email address. Give me a tinkle and I'll be delighted to hear from you in the future. Thank you very much indeed. And I'll hand you back now to Philip. I'd just like to thank Philip and, by the way, Barbara McGoldrick as well, for the great organization and presentations that they've been doing as well, and help and support that they've given us all. Thank you.
Okay, thank you very much, John, there, while Barbara's getting our pictures back up there. A couple of questions there. One question there, John, you mentioned there about your credit ratings and stuff.
Yeah.
How often is it updated, and when does, if things can happen, people so if something did happen, when does it no longer relevant?
The way it works, John, is a good question as well, Philip, in that there's about 142 members of the Central Credit Register.ie. They pay a fee in, and what they do is they're updating as you pay your car loan, you pay your mortgage, you pay a personal loan. They're giving information to the Central Credit Register that you've made the payment this month. Once you've missed a car payment, they also mention, by the way, this guy's missed a car payment, and there's a blip there. So then when somebody else is looking to say, will we give this fella another car loan? Well, hang on a second, he just missed a payment. We're not going to give him. So it's updated on basically a monthly basis. So if you have any issues, like if you have, for instance, a judgment against you, you can forget about getting anything for life, because that's there for life. You know how long one payment, if you miss it, is there for? It's 5 years. So you have to wait 5 years before that one payment is taken off the register and it's not there any longer. So you'd have to have a really, really good story as to why you had that blip in order to get a lender to accept, your application.
Thank you very much, John. We have a couple of questions in there, so I'll fire them out to you both there. John from FPD, is there tax relief and serious illness cover to cover payments?
Not on serious illness cover, income protection, yes, but tax relief on serious illness cover, simple answer on that is no. It typically forms part of a financial cover, what we call a family cover policy, with life cover and serious illness cover working in tandem. So the payout is tax-free, so that's, I suppose, some consolation in relation to, but in terms of the contributions I make, there is no tax relief for that.
Another question there for you, John, there again. Why would I need income protection if I'm out sick? Is it not covered by my PRSI contributions and sick benefit?
It depends if you're, a valid point, I suppose. Depends obviously what level of salary you require if you're off work being sick. So state pension, sick pay is around about €200 a week. We'll call it 11,000 euros a year. If you're used to living off a salary of, multiples of that, and you're off work for an extended period of time, there would be a quite catastrophic readjustment required in your day-to-day spending habits to be able to survive in that situation, I would have thought. So
can you get both?
Well, in terms of your income protection policy, 75% is the gross value of your salary that you can cover, but that's minus any your sick pay entitlements from the state if you qualify for them. Remember, sick pay entitlement then as well is means tested as well in relation to your family situation. So if your wife or husband or partner, should I say, is earning quite a bit of money, and you have exhausted your initial sick pay entitlements, the long-term sick pay is a means tested benefit. So there's no guarantee you'd actually receive it in that situation.
Okay. The question, I suppose, a little bit for you both there, and because it applies there, John, you were talking, John Lowe, the money doctor, about mortgages, and I know it's FD covers up life assurance, if you know what I mean. Is it like, I mean, people usually when you go in for a mortgage, you actually get your life assurance to cover your mortgage if anything happens. You're like, is that enough? Should you be doing more?
Well, first of all, it's mandatory to get life cover for mortgages. You have no choice. Sometimes if you're over 50 and you've got one foot in the grave, you might be able to get it waived by the lender. But generally, even after that, they still want some kind of life cover. Where I think life cover is important is when you have dependents. And there's a lot of people who get a separate policy for their children, but their children are now in their 40s and they still have the policy. I think that you should have a policy specifically for the children in case anything happens to either one of the parents up to about 22. The child is 22 when they finish their third level education. That's...
Dear John, there to you again, there's a question there about mortgages, like, and the switching. Is it something you advise? Is it something you should do? Should you go and go to your bank, get your mortgage, and you're done?
God. This is a brilliant time of the year, Philip, to assess and review your mortgage, because that is your single biggest cost. I've met lots and lots of people who are paying 3.5% to 3.9% on their mortgage, and they're just oblivious to it. So you need to go and check, number one, what rate are you paying? Number two, have you still got the ability to be able to justify that mortgage? So you need to know 3.5 times your joint income. Three, have you got the loan to value right? So 80% is the maximum loan you'll be allowed to transfer. So if you've got 100% mortgage, or your loan is equivalent to what its value is, you won't be able to transfer it. And the fourth thing is then the central credit register.ie to make sure you haven't got any blips there. So if you do those four things, then you should definitely go and shop around. There's some absolutely brilliant deals there. As I say, 1.95 fixed for 3, 5, 7 years, much better in your pocket. I can tell you that much.
Another question there for you, John, came in there about, like, mortgages are very regulated, as you went through, and there's quite strict schemes and regulation. When people start looking outside the mortgage as an investment, whether that be land or buy-to-let properties, how are they looked at?
They are. There are some lenders out there, would you believe, remember this old thing about interest-only loans? That used to be a thing of the past nearly, 15 years ago. Bank of Scotland were one of the first exponents of interest-only mortgages. I mean, I remember getting a 40-year term for a client, interest-only, for the full 40 years. They're still, one couple was in there about a year ago or so, and they were so ecstatic because it saved them basically during all that running. As far as the kind of payments and interest only, that interest only is back again now for residential buy-to-lets. So again, a lot of your members who might want to buy a kind of residential investment property, you can get now a 10-year interest only loan, just interest only, and after then the 10 years the capital and interest kicks in. But by that time you might have built up a kind of a sinking fund that will actually pay the capital back. So yeah, it certainly is. Residential buy-to-lets, even commercial lending is now, especially if you've got some kind of a business and you want to kind of buy a shop front, that's exactly what that's for.
John, a topic, and I suppose it's a personal topic, I'll admit, is people with kids. Like, I mean, I have a small family around, and I know from working with my own clients within my own job, education, third level, it's eye-wateringly cost. Like, what would you advise people with saving for future education costs? What way is it? Open a post office account, or what sort of things do you see people doing, or what should they be doing? John, FBD.
Well, a lot of people would set up, they would have regular savings accounts, but the more popular ones for the longer term savings accounts will say for a guy who comes in and, like yourself, younger children, colleges, in the future, but it's, you know, it's coming down the tracks. They would use a unit-linked regular savings investment plan. So you'd invest a certain amount of money each month. That money would be used to purchase units in a fund. So what you're hoping for then is obviously growth in the value of that fund over a period of time. So along with the contributions that you make, the fund value would increase as well, and you get a return, you know, over and above what depositor rates would offer during the same period of time. The best example we could give on that is, I suppose, is the SSIAs that were, you know, on the go. It's a long time ago now, I suppose, but in terms of those, there was two main types of SSIAs. There was deposit-based SSIAs, and then there was equity or unit-linked SSIAs. The unit-linked SSIAs far outperformed the deposit-based ones over the 5-year basis, because the fund values went up on average across the board. So if you're able to commit the time and the regular premium for that type of arrangement, it's an excellent way to gather up a decent-sized college fund.
I can't tell you
Is there any tax reliefs on those?
No, not yet.
I can tell you, Philip, that you know, on the deposit base, John is absolutely right. The very best regular saver account that's on the deposit is the Ulster Bank, who's going shortly, at 0.85% at the end of the year. That's even before dirt tax. Take the dirt tax off that, you're looking at just over 0.5%. So, I mean, it's a no-brainer to go into a kind of a unit-linked or a managed fund, regular saver account. Absolutely.
Okay, question there roughly about John, FPD again, benchmarking. That was a topic that came up many years ago. Like, I mean, does that exist anymore with the state pensions? How does that work? Like,
well, you see, I think in terms of the state pension, there was a talk, obviously, that state pensions were going to be linked into the rate of inflation. I think, you know, in terms of state pensions, like we're making a lot of promises, and like it's a politically charged thing to say that the state pension is going to provide X, Y, and Z in the future. But in relation to the actual what's going to become of them, a lot of that stuff's going to go out the window, I think, as years go on, because as we've both alluded to, the actual amount of people that's going to be paying into the pot for the average person to claim out their pensions, alongside the fact that we're going to be living far extended lives on average than our parents and grandparents were, means that all that type of stuff it's a moot point if I'm being honest with you.
would you advise people on state pensions to pay into AVCs then, maybe?
Well, if you're already at the point of reaching retirement, like you're 65 or 70 years old, it's all about income. Like pensions, we can talk all night about how important pensions are, but from my experience in the business here, you have to be earning money to pay into a pension. You have to have the cash flow to be able to sustain making a pension contribution. So if you're in a situation where you've good cash flow, and especially if you're in the higher tax bracket end of things, it's the word no-brainer is used all the time, but this is the absolute no-brainer of no-brainers to be doing it. But it comes down, as I say, if you're in a situation where your cash flow is very, very tight, pay down some debt, do what it is, get your head above water. But when your income allows, get your pension going then and stick at it, basically.
I have a question here, which I think it might apply a little bit to both. Any advice around EIS investment options, and where do you go to look at them?
Well, you can go to the stockbrokers. I mean, all the stockbrokers have a basket of EIS. And I mean, these are kind of investment, you know, where there's tax relief available. And there's now that tax relief is available in the first year. I think you get 40% now. It used to be you get 30% and you have to wait then 4 years or 3 years and you get the other 10%. But now it's all up front. But you want to be really careful, because a lot of those schemes, people who put the schemes out, they know that the investor is getting tax back. And there's no compulsion on the person who's bringing out this investment to think about paying the investor back at the end of 4 years. There's an awful lot of them don't make the full amount. So you could find yourself burned a little bit. I'd be very careful.
Okay, but another question in here. I have a question from a young member, 2 years graduated, regular job after college, mid-20s. What should they be doing? Like, what would you expect? What should they be putting aside? What would you consider a starting sum to put aside for a pension at that age?
Yeah, salary is the important part of that. Outgoings and commitments as well. So, like 25, you know, if the ability allows and the outgoing commitments are low, you could really max out what you're paying. And remember, at the age of 25, if you're an employee and you're working for a company, there is limits as to the percentage of your salary you can actually pay into a pension and get tax relief on it. So it's like, I think it's like 15% at that level. So that probably is as good a starting point as any. The reality again in that situation, speaking from experience, if you're in a scenario, do you have a house? You know, what's your living arrangements? Have you that sort of stuff arranged? Or have you an nest egg built up for that sort of arrangement? Because we've talked a lot about saving money and providing for the future, but if you have the ability maybe to have a good chunk of money built up before you go to start building a house or buying a house, it really helps in terms of reducing the overall the overall mortgage liability you're going to have into the future. And again, from my experience, getting personal debt paying down it really allows for people to have financial freedom quite a lot of the time. So personal mortgage debt, if you can get that away from yourself, whatever, but business debt, totally different situation. But personal and debt is a way to, it can really hinder your ability to save into the future. So get that on the wraps and worry about the pension then.
John Lowe, the money. There was actually a topical, quite heated exchange today in the door between our Taoiseach and Mary Lou about the cost of rent, and then trying to pay for rent and try and save for mortgage. You were talking about having to. I suppose it applies across the country, but really applies up in Dublin. Like how do people manage that? What advice can you give to people who are paying high rent and at the same time trying to save to get a down payment to get a mortgage?
I had a prime example of my son who was renting in Rathmines, and he was paying 1,800 euros for this one-bedroom apartment in Rathmines in Cowper. And when I looked up on my phone that there was one available to buy to in the same complex, and I worked out that he could actually get a 90% loan on the purchase price, and the mortgage over 30 years would actually work out at half his rent. So that's the anomaly, is that for a lot of people who are paying huge kind of rents, they can't save as well as pay the rent. And that's, it's a catch-22 situation. And yet when they go to a bank and say, look, I've been paying, 2,200 a month, and why can't you give me a mortgage for 1,500? Because you have to still prove that you have the ability to repay the 1,500 a month, not the 2,200, because that's a tenant landlord situation where the landlord can just chuck you out. So it is very difficult, and the mortgage to rent has been changed by the government as well of late, which I think is a good move, where they're going to put many more millions in to help those people who can't afford to stay in their own home, and it goes then to a rent situation. But I think the Help to Buy scheme is not a bad scheme for those first-time buyers. If you're buying new, or you're going to build your own place, and for a lot of farmers in particular, that's precisely what they're going to do. They're going to build their own place. So they could avail, you'll build a pretty decent property for under 500,000 on any farm in Ireland.
Okay, I'm conscious of time, so I'm just going to have one last question to both of you. I suppose if you were to give one piece of advice or to people there today, if you were to say, right, so between now and in the next 5 days, you said 2 days, in the next 2 days, what piece of advice would you give people to think about, to go away and go, I think you need to go do this? I say, I'll go to you, John, there, and FPD first, and then I go to you then, John, after that.
Okay.
Anytime I talk to, I've done presentations and talk to people about financial situation, what they should do. The one thing I would think is that you need to educate yourself in terms of what have you got in place at the moment, and is it currently meeting your needs. So in terms of, we'll say, your pensions, your life covers, you need to review them. You need to sit down every year or every so often and see, are they still meeting your current needs? So book that review, talk to your financial advisor, find out is the current situation that you have the correct setup for you at this particular period of time. That's what I would always say to anybody, because it's like it's like a job. It's like getting your car washed. It's like getting, you know, going to the dentist. You need to fit it into your overall, you know, lifestyle and say, I'm going to dedicate a certain period of time each and every year to my financial fitness, as they say in this webinar, and stick to that.
John, I'll leave it last word to you.
Yeah, well, I would actually embellish what John's saying, only just, you know, expand it a little bit. I think that this is a brilliant time of the year to actually do a budget plan, and you know, just to find out how much does it cost you to run, you know, to run your life on a monthly basis, and that includes, you know, what are you paying into your pension, what are you paying into your mortgage. I mean, you know, if you look at a quarter, you know, a monthly kind of, even the TV license is 160, divide that by 12, that's €13.33. If you have that in your budget, then you don't need to worry when that bill comes in, because you provide it from your monthly income. So if you can imagine, you do all the rest of it and just make sure that everything is down to every single item, from your hairdressing to the church donations to your, you know, dog food, whatever you have, you put it down on a budget so that you know precisely what's there, because then you can plan with the surplus. And that's really what it's all about, planning with the surplus.
Okay, that was informative. It was, yeah, as you say, your knowledge and depth in this area is phenomenal. There's definitely, as I work in the financial services sector, and I've definitely learned something. There's a couple of questions I need to ask about myself, about my own pensions and stuff. Look, as I say, look, I can't thank the two of you so much for coming on and giving us the time here to our members. It's been, as I say, there's a mountain of knowledge there. Barbara has informed me actually that your presentations and the link to this actually recording of this will be up on our website within the coming days. So anyone who wants to come back to it, and we'll have your own details. So if anyone wants to contact either yourselves directly to talk about something personal, we'll have those details up as well. I'd just like to say, look, on behalf of myself, the ASA Council, and George Ransbottom, our president, thank you very much for everyone joining us tonight, and good night and good luck. Thank you very much.
God bless.
Good night, everyone. Thank you.